Hello, my name is Jacques van Helten and I am a visiting fellow at the Florence School of Banking and Finance at the European University Institute here in Florence. And today I want to talk about culture and banking. What is culture? Let me start with a well-known quotation from Andrew Bailey, some years ago, and now, of course, as we know, the Governor of the Bank of England. Quote, "My assessment of recent history is there has not been a case of a major prudential or conduct failing in a firm which did not have among its root causes a failure of culture, as manifested in governance, remuneration, risk management, or tone from the top," end quote. Within financial services, culture is often defined as a system of values and beliefs and, importantly, behaviors that influence how work gets done within the organization. Culture is a matter of overarching principles that everybody within an organization can understand, can relate to, and can turn to when in doubt. As another supervisor at the EBA noted, and I quote, "We define culture as the typical habitual behaviors and mindsets that characterize a particular organization. The behaviors are the way things get done around here. They are the way that we act and we speak and make decisions without thinking consciously about it," end quote. So why do financial supervisors and regulators think that culture is so important? Well, in the wake of the global financial crisis and unfortunately still ongoing events, misconduct events in financial services that we come across even today, the LIBOR scandal, HSBC's ALM breaches and the like, regulators have come to view that formal governance processes and material improvements in risk management or oversight are not in themselves good enough to ensure appropriate regulatory outcomes. Unless cultural mindsets and behaviors are embedded throughout the organization, the control environment can still be undermined. Now, of course, for supervisors, it's well nigh impossible to go into any bank as part of their annual SREP review, for example, and simply ask, "Show me your culture." But what supervisors can do is consider some of the following. They can look for evidence of meaningful review and challenge to policies, processes, and strategies at board and within executive management. They can investigate whether there is an appropriate level of influence and status of risk management and operational control functions to ensure effective challenge and check and balance within an organization. They can be looking for alignments of remuneration incentives and accountabilities with risk appetite and regulatory outcomes. They can look for clear linkages between strategy, culture, and values. And very importantly, they'll be looking for a tone of the top in setting, communicating, and challenging the firm's culture. So let's take a closer view of some of these considerations. Let's start with evidence of meaningful review and challenge. A board, you can imagine, may have one or two very dominant key individuals who enforce their opinions with the other members of the board being rather passive and complacent. This leads to groupthink. There may be evidence via the minutes of the board meetings that some members may not fully understand the risk profile at a very granular level and are unable to challenge the collective view. Instead, in this instance, a regulator would expect a board to have a broad mix of individuals, a diversity of thought and of gender, and evidence that it encourages and positively responds to challenge. Turning to alignment of remuneration of incentives and accountabilities with risk appetite, negative indicators could include, for example, incentive structures that encourage excessive risk-taking, or at least permit it. High bonus salary ratios, high commissions, target setting at the expense of good outcomes. Star performers could be lauded even if breaching policies and no meaningful behavioral controls such as supervision or security restrictions exist. Instead, regulators would be looking for a reward and incentive programs that are transparent and aligned to the achievement of the bank's culture and desired staff behavior. There should be, in summary then, what we'd be looking for is a supervisory starting point whereby a culture can either reinforce or undermine a firm's governance, risk and control frameworks. Post-global financial crisis, regulators across the EU have sought to materially elevate the internal status of control functions. And some years ago, the EBA's guideline on governance already noted, quote, institutions should develop and maintain a positive attitude towards risk control and compliance within the institution. If a firm's culture is not attaching sufficient status and practical influence to the risk and other control functions, that is a real red flag to supervisors. Which brings me to an interesting point. Why is culture so difficult to change? Now, the culture, of course, of a firm is developed and reinforced over many years. Staff learn to adapt to it and to succeed within it. Consequently, it can be difficult to change. Then there's the so-called permafrost syndrome, which refers to middle management and operational layers that remain attached to certain values and are highly resistant, often covertly, to behavioral changes. The best cultural changes, then, are not one-off exercises, but long-term programs with realistic expectations and underpinned by regular assessments and commitment from senior management. There is a key role for feedback and escalation mechanisms within firms that encourage communication and alternative views into the decision-making process. Finally, what are banks doing about culture, in a way? It all sounds very fine, progressive refinements in rules to lead to better and more prudent management of banks, long-term cultural change programs, and so on. But what has really changed? Culture should translate as a matter of good practice into codes of conduct, codes of behavior, which I spoke about earlier, where the culture is shared among the entire staff in terms of risk, in terms of compliance, and in terms of properly serving customers, of course, which is very, very important. Culture and control should go together. Generally, banks have established conduct programs and compliant measurements and have redesigned compensation structures with key risk and compliance metrics. Culture surveys seeking employee satisfaction and opinion are crucial, in my view, that core values are spread widely. There will have to be confidence in the leadership if the right values are to be applied. Bad behaviors should be penalized, and communicating on breaches is clearly what is now expected, certainly from the supervisors. Developing an outcome-based testing in addition to risk-based testing is also helping organizations to develop a greater ethical culture. So-called lessons learned documents are now regularly written with information on regulatory fines and examples of do's and don'ts in terms of behavior. Conduct metrics have been added, and annual performance reviews in line with risk management priorities are now required. Now, this is a long list of specific measures which, taken together, amount to significant enhancements in culture and corporate governance, and which have placed a stronger focus on customers and market needs. Yet, as all these developments have yet to be proven to be sustainable, as many, of course, have only been implemented in recent times, and significantly, they've been driven mostly by regulatory landscape and legislative obligations. In short, in my view, there's still some way to go before cultural changes are fully embedded and applied without pressure externally.